Did you know that the majority of Russia's oil was purchased in February by China and India? This is true even though the West has tried to restrict Russia's military activities in Ukraine by capping oil prices at $60 per barrel. India and China are purchasing oil at levels higher than the Western price cap, according to trader calculations, meaning that Russia is still earning a healthy profit. And despite the fact that some EU nations wish to reduce the price restriction in order to put more pressure on Moscow, a G7 source stated that the cap will not shift. Recent EU sanctions against Russia's oil product exports have angered Moscow. As a result, they have made the decision to reduce their daily output of crude oil by 500,000 barrels beginning in March. That makes up around 5% of their overall volume. According to some observers, it will be more difficult than before to get past these new limits. This is because it is more difficult to develop new markets for oil products than for crude oil. Though oil products are diverse, nations like China and India may process crude oil themselves and profit from it. Moscow has thus stated unequivocally that it would not conduct business with any nation that incorporates the G7 price cap into its agreements. According to the Economist Intelligence Unit, there will be two distinct global oil markets if the sanctions stay in place. Cheap Russian oil will be available in one market, and China and India will use it. There won't be any Russian oil on the other market. Russia made 50% less money from oil and gas in 2023 than the previous year, despite selling more oil to Asia. Moscow also needed to sell off its foreign currency to offset the loss. Thomas O'Donnell, an instructor at the Free University of Berlin, believes that lower oil prices and revenue could result from the new price cap system and logistical difficulties. He said that Russia had recovered from the prohibitions on selling its oil after the first year of high gas and oil prices. However, the US, the EU, and the G7 may now apply pressure on Russia. Russia needs to find new sources of income because it anticipates a decline in its oil and gas revenues this year. Additionally, experts predict that in 2024, China and India will likely have a significant demand for Russian energy, with Chinese consumers showing a greater interest in Russian oil than do Indian consumers. If Russian refiners are forced to curtail crude runs and Russian distillate exports are unable to find new markets as a result of the EU's ban on Russian goods, then Russian crude exports may need to rise. Some claim that the cap is beneficial because it keeps the oil flowing while decreasing Russia's earnings. However, some argue that it lacks the strength necessary to force Russia to halt its actions in Ukraine. The majority of Russian oil shipments from the Urals loaded in February, according to Refinitiv Icon, are destined for China and India. Actually, China has only received roughly 20% of this month's oil, with India receiving over 70% of it. Concurrently, the expense of shipping Urals crude oil dropped, and the savings were not as substantial as they would have been on a worldwide scale. As a result, after trading below the cap earlier in February, the price of Urals crude oil went back to the maximum permitted. India and China did not pledge to adhere to the price cap, but the Western nations anticipated that the threat of sanctions would deter dealers from helping them buy more oil than what was allowed. The mechanism was functioning properly, according to a G7 price cap alliance official. They admitted that variations in the market could result in variations in Russia's pricing breaks relative to other countries. Still, Russia's oil prices are far less than those of other producers. This demonstrates how international sanctions affect Russia. When transported to Indian ports, the Urals reportedly got a typical discount of $13 per barrel above dated Brent, while when shipped to Chinese ports on a delivered ex-ship basis, the discount was $9 per barrel. The cost of shipping a barrel to China and India from Baltic ports was $14 and $10.50, respectively. According to calculations made by Reuters, the price of the Urals in February was little over $60 per barrel when they were available for free on-board delivery to Baltic ports, plus a further $2 for transportation. Furthermore, because there are now more tankers available and better Russian port ice conditions, shipping rates have lately dropped. In addition, just 2 weeks ago, the cost of shipping Urals goods from Baltic ports to India dropped from $8.1 million to $7.5 million. In a similar vein, the price to ship these loads from Baltic ports to China has decreased to $10 million from around $11 million just a few weeks prior. However, over the winter, the cost of freight to convey merchandise from the Urals to China and India increased by more than $12 million. Despite the great distances, the dealers claimed that Russian oil suppliers must have found enough ships to maintain low freight prices. The global price of many types of oil, including Urals, increased when the OPEC+ group announced supply curbs in February. In January, the price of uranium was $15 per barrel less in Indian ports than it was on a day basis for dated Brent. In the meantime, the price per barrel at Chinese ports was approximately $11 less than the Intercontinental Exchange Brent. Furthermore, Experts claim that the strong demand for gas and oil from China and India contributed to Russia's survival. Therefore, despite the sanctions that Western nations have imposed on Russia as a result of its actions in the Ukraine, the country's economy has been performing well due to the strong demand for Russian energy. This is a result of China and India's substantial purchases of Russian crude oil. They did not support the sanctions or denounce Russia for starting the war, either. Due to China's heavy purchases of Russian crude oil last year, Russia is now their second largest supplier. It appears that this pattern is holding steady, as researchers reported that China imported more oil in February than it had in previous years. The amount of pipeline gas and liquefied natural gas that China imported from Russia climbed by 2.6 and 2.4 times, respectively, in 2023. These imports came to a total value of $3.98 billion and $6.75 billion. In addition, China's coal imports from Russia increased by 20% in 2023 to 68.06 million tons. India has emerged as Russia's top oil importer, bringing in a record-breaking 1.4 million barrels per day in January 2024. In addition, India imported 161.18 million tons of thermal coal in 2023, a almost 15% increase. Experts claim that in addition to dealing with high inflation and an impending election year, Prime Minister Narendra Modi is faced with a difficult choice. Although he has deepened his connections with the West, he still has a positive relationship with Russia. Analysts surmise that he might find it too difficult to resist the allure of low-cost goods from other nations. Turkey is already one of Russia's top consumers of coal and crude oil. Experts forecast that Bangladesh and Pakistan would quickly follow suit and boost their purchases of cheaper Russian energy. Furthermore, Russia has followed the lead of heavily sanctioned Iran and assembled a shadow fleet consisting of nearly 600 antiquated oil tankers in order to circumvent Western sanctions. According to Bloomberg, there has been a surge in the demand for oil storage tanks in Singapore, which suggests that Russian gasoline is being blended with other types of oil and then re-exported to evade detection. Additionally, shipments of coal and oil have mostly stayed at or near pre-sanction levels. What are your thoughts on Russia? And do you think they can overthrow the G7 price cap? Let me know down below. If you want to continue to learn about business investing and financial education, we have got this video waiting on the screen for you to check out. Don't forget to give this video a like and subscribe for more videos like this. Thank you so much for watching, and I'll see you in the next one.